Alright everybody, it's Sam from Liberty Bullion again. Today, quick video for you. We're going to be talking about how gold is money. So there's a famous quote by John Pierpont Morgan, the guy behind JP Morgan, the famous American bank. And he's famously said in the past, when explaining what gold is, that gold is money and everything else is merely credit. Now, that's a statement as true as and timeless as any that can be made. And I'll step through why. So, gold is money. Gold has been money for 5,000 years. Gold has backed currencies over that time period. Gold has been used in coinage for trade and barter. Gold has a 5,000-year history of storing value. Whereas currencies, fiat currencies, currencies printed out of thin air by governments, like the Australian dollar here in Australia, the US dollar over in the United States, the euro in the Eurozone, keep going from there. These are currencies that are designed to lose their value over time. So if you're your average person and you're saving up fiat currency, you're fighting a losing battle because the fiat currency that you're saving is designed to lose its value. So you may be sitting on a big pile of fiat currency and the amount of the fiat currency you've got isn't going down. You're not losing dollars per se, but those dollars keep buying you less and less and less every year, thanks to what they call inflation. So how do you get around that? Well, you hold what's real money, not currency, money. The difference between currency and money, from a definitions perspective, is that money holds its value over time, whereas currency does not. So gold is money. It's held its value for 5,000 years. It's going to hold its value for another 5, is my bet. Whereas fiat currency, Aussie dollars, US dollars, euros, designed to lose value. So, as a saver, as an investor, as someone that's trying to get ahead and do the best for themselves and their family, if you're saving in fiat currency, saving in dollars, even if you're getting a small interest rate on those dollars from the bank, you can still be moving backwards because of inflation. So let's step that out. Let's say today you've got some fiat currency in an Australian bank account. We'll talk about Australia, but this applies to the rest of the world as well. They'll give you, say, a 4.1% interest rate, a 4.5% interest rate, maybe somewhere between 4 and 4.5%, which may sound great on the front of it. You think, oh, well, every year I get 4.5% more Aussie dollars into my account. How good! I'm moving forwards. Not so fast. No, you're not. And I'll step out why. Yes, you're getting 4.5% or 4% more Aussie dollars into that account every year. Yes, you have more dollars at the end of the year than you started off with at the beginning of the year, but those dollars buy you less and less. So the Australian government will try and tell you that the current inflation rate in this beautiful country of ours is 2.7%. I don't believe that for even half a second. I look at my own personal bills, food, etc. I'm looking at more like 10% for myself. And everybody's different because the basket of goods that everybody consumes is different on a personal level. We all buy different things with our dollars. But for me, the inflation rate is more like 10%. So let's just say that it's 10% for ease of use here. And let's say that you're getting 4.5% from your bank. Oh, let's say 4% for easy numbers. So 10% inflation, 4% interest rate on your savings. Cool. Well, instead of moving forward by 4% every year, from an inflation-adjusted perspective, you're actually moving backwards by 6 percentage points every year. How do you get that number? Well, it's what you get moving forward, the interest rate, minus the inflation rate. So moving forward by 4 percentage points, moving backwards by 10. 1 step forwards, 2 step backwards. So you can start to see how in a system like that, you're never going to get ahead. You're going to move backwards. Why? Well, because for every step you take forwards with that little interest rate the bank will pay you, you're going to move backwards 2 steps because of inflation. Now, you might be thinking to yourself, Sam, that makes a lot of sense. How do I move forwards? It's a great question. It's one that faces every human being. The answer is, or has been for 5,000 years, precious metals. Why do I say that? Well, over the last 25 years, gold in Aussie dollars has averaged a 10% compound interest return per year. 10% every year on average for 25 years. That is more than double what the bank will pay you at the moment. And let's take it more recently. So in 2023, gold went up 13% in Aussie dollars, above the average. That was great. In 2024, gold went up 40% in Aussie dollars, 4 times the average for the year. And so far in 2025, gold is up over 20% in Aussie dollars. And we're only 4 months in, guys. So you can either put your funds in a bank account and lose out to inflation, 1 step forward, 2 steps back, or you can look at something like precious metals, which has held its value for 5,000 years and also historically performs extremely well during periods of high inflation, like what we're seeing at the moment across the world. Cost of living crisis, high inflation, whatever you'd like to call it, it is what it is. So make good choices, prepare accordingly, do the research, figure it out what you'd like to do, and take action is my advice on that. So, appreciate your time, everybody. Have a good one.